Welcome to Passive Investor Ed 2020, the ultimate virtual conference for passive real estate investments, presented by Elisa Zhang, Kavita Baratake, Raj Tekchandani, and Ramesh Nachiappan, with our keynote speaker, data-driven mad scientist of multifamily and CEO of Grow Capitus, Neal Bawa.
Raj, take it away.
Can you move to the next slide? We have the keynote address. So let me just, people who don't know Neal, here's a brief bio, but hey, the man, the myth, the legend, finally here with us today. I don't know how much can I say. This is a guy that has inspired me personally a lot. And I'm going to not read his bio because every time he gives me a bio, by the time he comes to the show, he has done so much more that it's hard to keep up with. The guy known as the mad scientist of multifamily, but he's doing so much more than multifamily. He's one of the most demanded speakers in the circuit. He's a data guru, a process freak. I don't know how he does this. I've asked Neal, but someday I'll get to his secrets. But man works like a robot, and he's just always working. And his mantra is, we can only manage that we can measure. Beautiful mantra. That's something that I believed in, coming from the data background that I come from. Just an amazing guy. And we brought him as a keynote speaker because I have every chance that I get to listen to him. I've always been on that. So here you go, Neal, bring it on with all your magic.
Thanks so much, Raj, and thank you, Kavita and the team, for putting together this conference. I have to say that I'm getting a little bit lazy, Raj. Last year, all that flying around, speaking, I think I spoke at 15 conferences last year. This year, I get to sit in front of a computer in my shorts and reach out to larger audiences in some cases, both, when you look at the live audience and the recorded audience. I don't know if I'm going to like going back to that previous world, but today my update's really about the market and what's happening in the marketplace. Obviously, as you can imagine, a lot of it has to do with COVID, but there's a lot of other interesting elements that I'm seeing in the marketplace that I want to bring in. This is a geeky presentation, but it's also going to be fun. I'm going to share my screen. Actually, I'm going to share my audio as well. So, because there's a little video clip, a couple of video clips that I want to show you guys. So this is about 35 minutes, and I wrote it as a market update, and then I said, okay, well, you know what? This is really about real estate opportunities. It's about opportunities that have been created. Many of them are once in a lifetime sort of opportunities that I didn't think would be around. And they're only around because of COVID, right? If there was no COVID, then these opportunities wouldn't be there. In fact, I've been warning people for a while that, look, opportunity is dropping. Everything's super expensive. I can't really find high quality opportunities. And then everything sort of changed in March. And now I'm seeing a lot of opportunities. Today, for the first time in this webinar, I'm going to name what I believe is the biggest opportunity over the next 10 years. And it hasn't been mentioned by me in any of the webinars before. I've been researching it for months. So we'll finish with that one because it's a very big one. What I'm going to do now is I don't want my video to cover the screen. So I'm going to turn my video off and I'll turn it back on as soon as I finish the presentation. So here we go. Let's talk about real estate opportunities sparked by COVID. All right. So this is a timely presentation. Obviously, a lot of it is about the impact of the most powerful black swan in modern history. So it's critical knowledge presentation, but not Netflix binge watching, right? I'm not here to scare you, but the fact that you're here means that you are concerned about the impact that coronavirus might have on the economy, on the market as it stands today, especially on the multifamily market, because a lot of you guys are interested in multifamily. Since I've already been introduced, all I'd like to say is I love experimentation. A lot of my portfolio is about experimenting, and it's led me to lots of interesting areas that I didn't think I would get into. I didn't think that I would be building industrial properties. I didn't think that I would be in a tertiary market building townhomes. I didn't think that I'd be doing student housing or self-storage. But I enjoy experimentation, especially data-driven experimentation. It's led me to lots of interesting places. A lot of my investors, they like that, they enjoy that, they're seeing the benefits of it. We're distributing millions of dollars of cash flow every year to our investors. Currently, the portfolio is about 320 million. And we don't really looking to grow our portfolio in any way. So there's no goals for us. If it drops to 200 million, we'd be just as happy. What we're interested in is learning about new opportunities, learning about new concepts and ideas in the marketplace that could take us to places that we haven't been. Here's a sample of our portfolio. As you can see, it's very diverse, right? So on the left, the grid just opened, by the way, opened a week ago, 217 unit student housing. And by the way, those of you that are thinking it's a bad time to open student housing, we've had a phenomenal lease up. Woods Cross is a flex building. It's industrial with some office. Storage Depot obviously is a self-storage facility. And then above that and below that, you see lots and lots of multifamily, some new construction, some old, some very, very old. So we like to do a mix of things because it gives us lots of interesting things about our projects. So I used to show people lots of slides about our projects, and eventually I said, what's most important is full circle investors, people that have invested with us and have benefited after we've sold these projects. And here's a review from Sarah. She actually has about 24 investors, 24 syndication investments. And so I'm happy to receive a review like that from Sarah. Here's another one. This gentleman actually has invested in 6 of our projects. He's a data-driven guy, very technologist, lives in the Bay Area. And so we just had a successful exit with him. And what he really likes is the way we vet projects and our transparency. So those are some of the things I wanted to tell you about before I jumped into the presentation. Here's the good news. This is usually the most boring slide in my presentation, but I don't have to do this because Raj and team have already told you about the risks that you take when you come to an educational event and the fact that you have to do your own due diligence. So now I'm going to get started. All right. So when I look at the economy today, obviously COVID is the 800-pound gorilla in the room. So what are we doing? Well, what we did is back in March, we created a new methodology of tracking the economy. And we built 6 trackers, some of which we already had before, and some of which were built custom to track the impact of COVID on real estate and on the US economy. So let's start with that, right? Because numbers really tell a powerful story. So our first tracker is about jobless claims. Nearly 12 million people have continuing job claims at the end of September. At the end of October, it actually dropped a little bit down below 11 million. So that's good. But the problem is in this blue graph, right? Yeah, a lot of people are like, unemployment is dropping. Well, they're not looking at this blue graph. The initial claims number is remaining very stubbornly high. As of September 26, it was 837. As of the end of October, it's still just slightly under 800,000, right? So this is what the US economy looked like before. On the left side, you see there? Less than 200,000 new initial job claims. And then we had millions and millions and millions of them for months. Now that we think we're recovering, well, we're still at 4 times the initial jobless claims. And some of the data that you're seeing is so tainted. I saw data yesterday saying US unemployment drops to 6.9%. Then I dug into it and I realized to my absolute dismay that they've dropped like 7 or 8 million people simply because they've been on unemployment very long. Well, they're still unemployed. Simply removing them from your numbers doesn't change the reality, but that's what is being reported in the media. It's absolutely horrific that people are actually reporting this stuff. And when they're reporting it, they don't put a caveat right on saying they're dropping millions of people from this list that are still unemployed. So that's the first tracker that I'm looking at, and it's not looking good. The second tracker actually is much better, consumer confidence, because people spend money when they're confident about the economy and their jobs. And while optimism suffered a record plunge in April, see it right here? Well, now it seems that it's, consumer confidence is sort of tracking COVID cases, right? So at the moment, we've seen a very significant up spike where consumers are buying again, beginning to see retail numbers in the US improve. And what we're worried about is we're about to see the biggest COVID spike of all. Europe's already seen it. They're about 4 or 5 weeks ahead of us. So I'm curious to see what this number is going to look like. But for the moment, that confidence number actually looks pretty darn good to me. So tracker 2 is a big thumbs up. Tracker 3, we're tracking gasoline. And this tells us how quickly the economy is bouncing back. And here we've got nothing but good news to report. So oil usage has bounced back close to pre-pandemic levels. Now, some of this is being driven by long road trips, no pun intended, but because people are hesitant to fly, so they're basically driving instead of flying. But overall, still, this number is much healthier than anybody anticipated. We certainly didn't anticipate it. So the bounce back in oil, strong positive indicator. Our fourth tracker is same store sales, all right? Retail sales are so incredibly important to the economy, to the health of real estate. And while we saw same store sales decline by as much as 9% in the previous months, there was actually a bright spot in August. Same store sales rose by 5.6% compared to 4.6% from the previous year. So it was even better than it was in August in 2019. So there's a lot of pent up demand here and consumers are buying. By the way, I haven't updated the graph here, but I just saw September numbers. They were equally good. So at this point, retail sales are making somewhat of a comeback. We don't know what happens when COVID numbers rise, but at the moment, it looks actually pretty darn good. Our fifth tracker, which is designed specifically for the COVID era, is daily airline passengers. So here the news is really bad. We've seen a 75% decline in passengers. And that decline, as you can see on the right there where the arrow is pointing to, well, it's not correcting, it's dipping again. US airports look haunted. The TSA provides this number daily, so I Googled it, and yesterday's number was 901,000 people went through TSA checkpoints. 1 year ago, 2.5 million. So as of yesterday, the drop is over 65%. So staggering decline. In my mind, this is really, really going to hurt. And then our last tracker is home purchases. No secrets here, but the US single family market is on fire. Mortgage applications up 27%, refinance is up 86%. Home buying is critical to the economy, and it's very, very fair to say that the Fed did the job that the White House has failed to do on the economy. And this is by far the most positive indicator, right? So we've got two indicators that are hugely negative: jobs, airlines. And we've got two that are neutral: consumer confidence and oil. And now we have two that are positive: same store sales and single family housing. Now, keep in mind though, the prudent investors who don't want to lose money are going to say, Neal, but the jobs are the 800-pound gorilla. And I'm going to respond with, yes, you're right, but I think housing is also a big gorilla and it's doing really well. So it's not all gloom and doom in the real estate market. Okay, so we looked at those 6 trackers that Procapitus, my company, is using to track the pandemic, get some insights into what the numbers mean. Now let's dive deeper into the crystal ball and talk about some key trends that are affecting everything in the marketplace. These are, things that you should know about if you're looking to get into multifamily or looking to get into any kind of real estate, honestly, in over the next 12 months. So let's start with the biggest and most important mega trend of all. Real estate's actually again becoming extremely lucrative to investors because of this thing called the yield premium. It's the second widest on record. And you're like, what? What the heck is this thing called yield premium? Well, to figure that out, you have to look at my favorite graph, the one that really controls our destiny in real estate, right? This is the spread graph, right? As it turns out, it isn't presidents, it isn't parties that control what happens to real estate. It's the gap, the spread, the margin between the average yield of real estate and the price of 10-year treasury bonds. Treasury bonds in real estate in this orangish color, right? So look at the left side of the graph. In 1990, it was a horrible idea to buy real estate. Why? Because you could just buy 10-year treasury bonds and make 8%. Why would you take all that extra risk and only end up with 1%? Well, over time, things corrected because treasury prices went down. And so we got to this point where you could basically make 4.3% more on average in real estate by taking the risk. This is what we call a balanced economy, where real estate makes at least 4% more when you take that risk of buying real estate compared to buying treasury bonds. So equilibrium, this is good, But then in 2005, 2006, real estate became hugely expensive. The yields cratered. And then we saw what happened in 2008, right? So this was a indicator. This is why people were screaming, saying there is no yield premium, there's no risk premium in real estate. It cannot last. And those people turned out to be right. And so what happened is we had the reverse happen, right? So obviously the Great Recession took treasury yields down. They cut them down to 3% or below that. But at the same time, the yield on real estate went up because real estate got cheaper. And so this was the single greatest time in history to buy real estate. 2012, 580 bips, huge. This is crazy. Like the amount of benefit that you're getting by taking the risk on real estate was mind-blowingly high. And of course, we saw how many investors benefited in this 2012 to 2018 timeframe. But once again, everything's a cycle. So as you can see, slowly the yields on real estate continue to go up as prices went up. And treasuries over time sort of went up a little bit, right? Because the Fed started to raise rates and we got to this danger point. So by 2018, everybody was saying, hey, real estate's really too expensive. And I was beginning to think that it was, because we were getting to that cutoff point. Below 400 bips, institutional investors say, I'm not going to invest in real estate because there's not enough premium for the risk that I'm taking. And so we were beginning to see people walk away. But just in the nick of time, the Fed started to drop interest rates again. Now, notice that on this side, a lot of people are saying real estate's getting more expensive. This is a flat line. As real estate has gotten more expensive, rents have gone up. So the profit that real estate makes is the same between 2018 and today. It makes the same amount of money. So that's a myth that I want to bust, that real estate's very expensive compared to 2018. No, rents have kept up with price increases. Real estate makes the same amount of money as it did 2 years ago. So what's really changed? Well, it's treasury yields, right? So today when you buy a 10-year bond, you're basically getting 0.7%. So obviously this margin curve now is the second widest on record, the first widest being here, right? And you know what happened to real estate in the 2012 to 2018 timeframe, right? You made mistakes, you got rich. You made lots of mistakes, you still got rich. That has come back, and it's come back because of COVID. Incredible opportunity. Understand this graph, know what it means, and know that the stuff that's happening with what the Democrats and the Republicans are doing doesn't actually control your money in real estate. This graph does. The second megatrend was the fact that this recession was bizarre in that job losses are not across the board. Some sectors like leisure and hospitality were decimated, right? 600% increase in unemployment year over year. Surprisingly, education and health services, they were also hit very hard with 400% increase in unemployment year over year. Oil and gas, manufacturing, big hits. Retail, transportation, big hits. Construction didn't fare well. Well, actually, sorry, construction did fare surprisingly well, all things considered. And I think it's because a lot of states deemed it essential. And then you had these three sectors in blue: IT, professional and business services, financial services. These are hardly affected. This means that white collar jobs have done a lot better than blue collar jobs. Now, that's bad news for Main Street, but it's good news for you, for real estate, because it means that the single family market is not hurt. Blue collar workers don't buy a lot of single family homes. For apartments to do well, single family must do well. So I'm actually very relieved to see this second megatrend. I'm seeing single family owners doing really well with their jobs. And here's something that I want to be honest about. COVID's really made me into a liar. For years, I've been telling my real estate community that jobs matter, but other factors like population growth and income growth and home price growth, they also matter. Right now in this bizarre COVID matrix that we live in, the only damn thing that matters in the short run are the jobs, right? And then there's this gigantic, massive gulf in unemployment rate between US cities. So this is completely unequal, right? So you look at Salt Lake City, red hot Salt Lake City at the top of the list, it's only lost 1.5% jobs. I recently went to Idaho Falls, my favorite market in the US to invest in. And the only way to get to Idaho Falls is to go to Salt Lake. I go to Oakland Airport and it looks like a graveyard. I land 1 hour and 15 minutes later in Salt Lake City. It looks just like it did in Feb. I couldn't tell the difference. The airport was hustling and bustling, and people were in masks, and because it's a requirement at airport, people were in masks, but there were just as many people there. There's no impact on their economy. The same thing's happening in Austin. The same thing's happening in Phoenix. These economies, Phoenix was very careful. They didn't do a full-scale shutdown, and it benefited them, right? So there was actually a benefit. Yes, they're seeing the impact in deaths, but right now I'm just talking about your pocket. So give me a chance to be purely logical and heartless. Phoenix not shutting down benefited them a great deal. Same thing happened with Dallas. So Dallas is a very strong market. Indianapolis actually was a surprise. I didn't expect Indy to be in this list. I did expect Atlanta to be there because the Atlantean economy is so strong that despite a severe shutdown, they were able to bounce back very strongly. Denver's got a lot of tech, so they did well. San Antonio, and in general, all of the cities that were in Texas did pretty well because they were very resistant to shutting down their economies. So at 8, you see San Antonio, 11, you see Houston, Dallas is up here at number 4. So bottom line is the Texan economies, the Floridian economies actually bounced back faster than some of the others. And so did economies in Tennessee, which is kind of a new hot state, right? Nashville, Knoxville, Chattanooga are markets that are doing really, really well. But in the middle, we started seeing some of these blue markets that, that were, that may not necessarily have, resisted the temptation to do full-scale shutdowns. So you see Seattle here at 7%. You see Sacramento, Columbus, Ohio. Some of these, bigger markets, especially San Jose, they didn't. They focused only on the one side of the equation, which is, we've got to shut down, we've got to prevent deaths, and they started to get hit a lot more. I'm a liberal Democrat, but even I can tell this, that if you just leave your city shut down, you're going to lose a large amount of life because people will not have jobs. People will die from hunger. People will die from depression. And so there was this lack of balance in the last few months. And you can see that easily in the numbers, especially on this next slide. Right? So these are the ones that got hit the most. Obviously, we know why Las Vegas got hit the most, right? There's no tourism happening. But take a look at how many of these are blue cities, right? Large blue cities that basically said, we're going to save every life that we can. And in doing so, they basically set fire to their economy. New York, Boston, Los Angeles, all of these are cities that were hurt really badly. Now, Portland was also hurt by the riots. They didn't do as aggressive of a shutdown, but they had riots going on. These are the cities that are hurting. The point I'm trying to make on these slides is simply this. Don't think that this is an equal recession. It's not. Salt Lake City, 1.5% of jobs lost. New York, 13.5%. Very, very unequal recession. Right? And then obviously the third mega trend, of course, today is the nationwide eviction ban, right? So as you know, the CDC issued an order protecting anyone that makes less than $99,000 a year from being evicted. Let's dig a little bit into that ban. And this applies to all states. Tenants have to attest that they cannot afford to pay rent because of loss of income or medical expenses. They've tried to get government assistance. They've used their quote unquote best efforts to pay a portion of the rent. So protection isn't automatic. They have to submit special documents that are provided by the CDC to their landlords. And tenants who provide false information can face, fines or jail time for perjury. Here's the catch. Rent is still due. It's just delayed. So the tenants actually have to make larger payments in the first half of 2021 to catch up. And let's talk about what that means for landlords. I mean, the honest answer is the landlords are out in the cold. With this new moratorium, some landlords in the country will end 2020 without having received rents for 9.5 months. And there's absolutely nothing that can be done about it. I come to conferences like this and people are only showing the good side. Oh, multifamily is doing really well. Our collections are only down 1.5 or 2%. But those numbers actually that people are quoting, once again, don't make any sense to me. So I dug into them further. What the NMHC, which calculates these numbers, the National Multifamily Housing Council, is saying is, well, if a year ago, 94% of the tenants were paying, today, 92% are paying. But what they're not saying is that a significant percentage of those 92% have paid portions of their payments. Maybe they're making half the payments. Maybe they're making a quarter. Maybe they're making 3/4. So when you actually look at the amount of money that is coming in, it's not 92%. It's not even close. Also, we're beginning to see an uptick. So there's actually a gap developing between what was paid last year and what is being paid this year, probably because there's, we've got this PPP and EIDL and all of these other things ending. And that's why it doesn't matter if you're a Republican or a Democrat, you're talking about another new stimulus package because they know that without that stimulus, the economy is going to run out of steam. So at this point, the chances of a stimulus, in my mind, are almost 100% because there's clear evidence that we're running out of steam. So let's watch this quick video about the US of A, an eviction-free zone.
Okay, Diana, it's Brian. I'll take the side of the landlord then. Yeah, I'm not talking about the big corporate landlords with 10,000 apartments run by billionaires. Talking about families who made a living owning, 6, 8, 10 houses. How are they supposed to survive without them getting rent?
And that's the big question, Brian. Look, you've got a lot of mom and pop landlords out there who have to pay the mortgage, have to pay the utilities, have to pay the taxes on those properties, not to mention that a lot of that rental income is their own income. Now, on the call last night with senior administration officials, they said that there was some HUD money, some community development block grant money that could go to landlords, but it was unclear how the landlords would get that, what they would qualify for. And remember, a lot of them have not been seeing rent for several months now already. And the last time we had a major eviction moratorium like this that expired in July, that was the federal one that went into effect at the beginning of the pandemic, that went along with stimulus checks as well as extra unemployment benefits. And a lot of tenants use that to pay the rent. They don't have that now. So you're starting to see the numbers of rental delinquencies creep up very quickly, and that's really hitting landlords hard.
And keep in mind that the National Multifamily Housing Council only has access to large apartment owners such as myself and Raj's group and folks like us, right? So they're looking at that data. But what about the people that have 6 plexes, 10 plexes, 20 plexes? They're not reporting their data to the NMHC. Well, they're seeing significant delinquencies as much as only getting 40 or 50 or 60% of rents. So guess what they're doing? They're cutting rents, right? They want to do whatever they can to maximize their occupancy and get it up to 100%. And that cutting of rents is eventually going to trickle down, but trickle up to the large apartments, and we're beginning to see that happen as well.
Okay.
So really, there's a domino effect that is hitting the rental industry hard, and you haven't seen it yet. A lot of people are like, multifamily made it, whew, we avoided this. Well, no, we're just in the 4th inning of this. The way I see the math, it's in the 4th inning. For anybody who thinks, well, we're not in the 4th inning, I want to just remind you of one thing. When it was April, what were you saying? Oh, by June, it'll be better. When it was June, you were saying COVID might, they might find a vaccine by the fall. Well, now we're late fall, early winter, and now we're talking about spring. There is a natural tendency that human beings have of not being data-driven and saying, in a few months, it will be better. Where the data doesn't show any evidence that in a few months, it will be better. All right, I'm going to actually skip past California because a lot of you guys are not Californian. And this was the chart that I was talking about with the NMHC. I've seen this chart shown at conferences throughout the US as a sign of victory. It's like multifamily won, like we were in some kind of weird race. No, we didn't, because a ton of these 92% are partial payments. And remember that even if the industry was doing well, this is just the top of the industry. This is just the top. This is only 11 million apartments. There's 7 or 8 million others that are not being reported. They're seeing high delinquency. And as they drop their rents, it's going to start affecting the industry. Okay, I'm going to move on to my last mega trend, and that's suburbanization. It's
Hey, Neil, can I
trend.
quickly interrupt?
Yeah.
There's actually a bunch of people from California, and the chat box is lighting up saying, whatever you had to say about California, can you just briefly say it?
Well, yeah, to me, I think the big one was that I'm going to go back and talk about the fact that California has its own eviction laws, right? And it's actually stronger than what we are seeing throughout the US. It runs it on Feb 1st, and Gavin Newsom's already mentioned that he's going to extend it. There's no income cap, tenants have to pay 25% of the rent, and basically they can keep staying there. From what we are seeing, that the California market is undergoing a much more severe problem than the national market when it comes to multifamily. It's much more severe. Rents have dropped 9% in San Francisco. They dropped 2.5% in 2008. We're also seeing record vacancies in both New York and Los Angeles. So I can tell you that there are 2 markets in the US right now in serious trouble for multifamily. And they are, well, 3 actually: Los Angeles, San Francisco Bay Area, New York. These markets are going to see extraordinary drops in rents and prices over the next 12 months. That's what I wanted to cover in California. Everything I just said to California applies to New York equally. Moving on. Last trend, suburbanization, right? Trend of people going to suburbs and possibly to other cities. This is a huge moneymaker if you understand this trend. right? And keep in mind, this trend did not start with COVID. There's a lot of people saying that. It's just total and utter nonsense. It actually started in 2010, and then it accelerated in 2018, 2019. So it's silly to say that this is a short-term COVID-driven trend and people will come back. It's just absolute nonsense, right? Look at this guy, Robert Herjavec. He's one of those investors on that TV show Shark Tank. This is one of the greatest moves to the suburbs from urban areas since the 50s or 60s. He said this before COVID. Listen to this other guy, even smarter guy. His name's Glenn Kelman, CEO of Redfin for the last 15 years. This guy tracks the numbers like no one else. Listen to what he's saying.
Glenn, are you seeing signs of this as well? I mean, do you think this flight to the suburbs could have legs?
Oh, it's a massive migration. We're seeing a great dispersion of Americans across the country. Why would you pay the tax to live in San Francisco, Seattle, New York, Los Angeles, when you could have the same job but be in Charleston, South Carolina, or Sacramento, or Grand Rapids, Michigan? So we see many people refiguring where they want to live. They want to spend more money on their home, but they don't necessarily want to pay the tax to live in an urban area.
Yeah, it's a Lollapalooza effect.
And here's proof. Take a look at this graph. The orange line shows the vacancy rate for the suburbs in the US in 2010. As you can see, the downtowns were more in demand, right? Their vacancy was like closer to 4.5% or 5%, and then the suburbs were at 7%. Now notice this is 2010, and then each year this shrinks. By the time it's early 2018, the suburbs have the same exact vacancy as CBD or central business district. So everybody who says this is a short-term trend has not ever seen this graph. It's very clear that this was happening in the last 10 years, and it's now accelerating because of COVID. We are seeing cap rates go down in the suburbs. We are seeing cap rates go up, which means prices are going down in the downtown areas in most parts of the US, not in every part of the US. So there's definitely some exceptions there, right? And telecommuting, this whole concept, in the last 7 months, we have trained 3 million CEOs on how to run their companies remotely, right? Even in the next 20 years, technology couldn't have trained those people because of preconceived notions. Now they know they can run them remotely. So even if 10 or 20% of those don't bring their forces back into the office, everything changes. We're talking about 1.92 million renters actually becoming homeowners, potential homeowners, by just moving. And they move from San Francisco either to a suburb of San Francisco, maybe 50 miles away, 60 miles away, or they just move to another place. And what are the cities, again, that are going to lose the most? San Jose, San Francisco, Los Angeles, because look at how many people here that are renters could become homeowners if they move. So the 4 big losers are right here, right? Denver was actually a bit of a surprise, but I think with Denver, they're not moving out of Denver. They're moving to Greeley. They're moving to Fort Collins. They might even move to Colorado Springs. So they're not really moving out of state, but they're basically just moving out of the Denver metro by itself. And the winners are going to be here, right? Orlando, you see Baltimore, you see Atlanta, Tampa, Charlotte, Houston, Jacksonville. These are the winners. Why? Because here, there's no benefit to people moving out. There's no benefit. You can't go from being a renter to a homeowner simply by moving out of this area. So there's no move outs, but there's a lot of move ins from these places with people moving in this direction. Again, was already happening. It's now massively, massively accelerated. 42% of people in the Bay Area, when surveyed, said that if their company allowed them, they would move. I don't think 42% will move. But if 5% moved, it would change the Bay Area economy. 40% in New York. If 5% actually moved, it would change the real estate economy of New York. I mean, just these are humongous trends, much bigger than anything that we've seen before. And here's some validation.
Hey, Rahel, the number of new leases in Manhattan falling 23% over the last year, rents falling by 10%. That was the largest decline in history. But the most troubling sign right now for the nation's largest rental market is the number of empty apartments. There are now 13,000 apartments listed for rent in Manhattan. That is an all-time high and more than double last year's total. Now, this is especially bad news for New York, since July and August are usually the strongest month for rentals as families prepare to go to school. It is still expensive in Manhattan. The average one-bedroom rents for $3,500 a month. But with so many people leaving the city, landlords are now offering an average of 1.7 months of free rent just to get tenants. Now, about half of all apartments in Manhattan are owned by small business owners, and without the rent, they may be unable to pay their workers and property taxes. And since property taxes in New York are the largest source of revenue, these rental declines could start to affect services, which, Rahel, could affect the attractiveness of New York and lead to even fewer rentals. So it's a bit of a spiral right now.
So obviously, I've mentioned some of the smaller assets that could benefit. I'm going to talk about a few that you may have not heard of. One of them is Idaho Falls in Idaho. Another one is Knoxville in Tennessee. I do not hear about these metros. My metrics show that these are going to do really well. And then if you're interested in Utah, in the Utah economy, which has done absolutely phenomenally well, you saw the numbers for Salt Lake City. The metro that stands to benefit the most is St. George, Utah. These three, Idaho Falls, St. George, Utah, and Knoxville, Tennessee, I don't hear discussions about them. I'm looking at the numbers saying, what? These are phenomenal metros. Why are people not talking about these? I'm going to skip past this. Well, actually, I'm just going to mention it briefly. Remember the trend that we talked about, vacancies between the suburbs and CBD? Same trend for offices. So employers are also moving to the suburbs. Suburban office vacancy is down, and vacancies in the city, in downtowns, is spiking up like crazy. All right, going to skip past some of these. So briefly want to look at self-storage, right? So this is the market that some of you guys have gotten introduced to you through this conference. Phenomenal market, actually. What we're seeing is that because there's been a huge number of people, 15.2 million people have already moved during the pandemic. And when people move, self-storage needs go up. So the asset class right now is doing well. Rents have actually been slowly increasing, slow and steady increases since COVID. Now, there is a huge amount of concern in the market about lack of construction loans for upcoming storage projects. So that's like this X factor that's hanging over the storage industry, but otherwise the sector is performing well for now. My storage projects, the ones that I've invested in, have done really, really well. All right. So bottom line is suburbanization trend is more spacious units in homes with home offices away from high walkability areas, away from downtowns. And I know that many of you think this trend is going to reverse when a vaccine is found. All I can say to you is I just proved it to you. It's been going on for 10 years and accelerating since 2018. All right, let's finish off with how the various asset classes compare. But before that, I'm going to tell you about one of my properties. So I'm going to take 60 seconds to tell you about one of my projects. Very lucky to be involved in this 240-unit new construction project in Mesa. Earlier in this presentation, you saw very powerful data that showed that job losses in Arizona, Phoenix, amongst the lowest in the US. East Mesa has actually been a standout. Its post-COVID rent growth has been amongst the highest in the country. And by the way, Phoenix is the #1 metro in the US for rent growth post-COVID. A lot of that is because Phoenix is the fastest growing US city. Maricopa County is the fastest growing county in the US. And it's also because Mesa is becoming a data center hub, with both Apple and Google opening jumbo-sized data centers less than a mile from where we're building our apartment complex. Here you can see the difference between Phoenix rent growth and the rest of the US. And that helps you understand why Phoenix is doing well. The demand for housing just absolutely incredible. Here are just some of the renders of our fully zoned, fully entitled, shovel-ready project in East Mesa. We're starting construction in a couple months. And remember, the state of Arizona considered construction to be an essential activity, so we're unlikely to see any disruptions from upcoming COVID shutdowns. Our investors invested about $15 million. We bought lands, we've gotten through city approvals, and now we've got all the money, pretty much all the money. We've got a few shares left to get the building built. So this project was sold out immediately, but some of our big investors have had stock market losses. So we have a few shares available. So you can take a look at those IRR and annualized numbers for a project that is fully zoned, fully entitled, all city approvals done, and almost all the equity raised. And by the way, in case you're wondering, our bank loans are coming in significantly cheaper. Nothing to do with us. Obviously, the market is what the market is. But given that COVID has dropped interest rates, our bank loans are coming in way, way cheaper than we projected. And if you're interested in learning more, you can check out, this is my email address, Neal Capitalist. You can also go directly to this page, Mesa-Kit, and you'll learn a lot more about this project. You'll also learn about other projects that we have available. And with that, I'm going to skip past these reviews. I think you saw some. I'm going to finish off the last 5 minutes here. I think I have 5 minutes left to talk about the various asset classes. How's the market doing for different asset classes? I gave you a teaser of that with storage because I didn't have storage on here. So the best asset class at this point that's performing really, really well is medical office. We have seen 99% collections on medical office in the last 7 or 8 months. No issue, no challenges at all. Multifamily obviously has done fairly well. I would say it's done well, right? So multifamily's done well. People have been putting money towards rent as soon as money comes in. Office doing well, but here's the catch. Office leases are usually 5 years, and a typical office tenant has, $500,000 in the bank or $5 million in the bank. So they're not going to default on their leases for a few months. The question with office is not default. They haven't really seen much default. The question with office is simply this: what's going to happen when those leases come up for renewal? That's where I'm projecting that there's going to be major problems in the office market 2 years from now. Not 1 year, not 6 months, but 2 years from now, I think we're going to see severe problems. That is not the case for industrial. So in February, when I was looking at the analytics for the real estate industry, it was clear that industrial was the #1 asset class in the US. #1 asset class. It wasn't multifamily. Multifamily was second. It was industrial. Why? Because of the Amazon effect. And then in the last 6 months, we got 6 years of e-commerce growth in the last 6 months. So at this point, we need billions of square feet of industrial space in the US just to make up for the incredible growth that we've gone through. So it was the hottest asset class in Feb, and now I think, I don't know what goes beyond hot. So red hot, white hot, that's where industrial is today. Note that rents have risen the most for industrial compared to any asset class in the last 6 or 7 months. Now, retail is interesting. A lot of people might say, oh yeah, it's a bloodbath, blah, blah, blah. Actually, single tenant retail has done fairly well. So, I'm sure they're not happy, but it's done fairly well. Where you've got the Rayleighs and you've got the Walmarts, those kinds of retail have done quite well. In fact, we've actually seen a little capital compression with more people wanting to buy single tenant retail. It's multi-tenant retail like strip malls that have done really, really poorly. So in my mind, both large malls as well as strip malls, there is an absolute bloodbath coming in the next 18 months. So I've already told you about medical office. I'm going to skip past this slide. And I'll tell you about the asset class that is the greatest opportunity, and it's the hardest hit. We cannot say the same for hotels. These are the hardest hit. Hotel occupancy rates have dropped from mid-60s to 47% in July. I just checked in the number for September before I came to this session, not much better, 49%. So you're about 31% down for the previous year. So the entire hotel sector in the US is now unprofitable. Hawaii at 18%, Orlando, 32%. Those are the two worst markets in the US. Here's what I want to point out though. This is what I want you to listen to, right? Don't you all wish that you'd gotten into real estate in 2009? Okay, right? So think about that, hold it in your head and listen to what I'm saying. Nothing is fundamentally wrong with the hotel sector. It's not overbuilt. Occupancy pre-COVID was fine. Profits were all-time high. So in my mind, over the next 6 to 12 months, as you see the short sales, as you see the defaults pile up, the greatest opportunity actually lies here. And by the way, I'm not pitching anything. I'm not into hotels, and I'm very unlikely to get into hotels. But to me, as I'm looking at the money that I have parked that's coming from multifamily profits, guess where I'm putting it? I'm putting it into people that are doing distressed hotel funds. This is where people will make a truckload of money if you're brave enough to venture into this market. And now's not the time because the defaults just started a few weeks ago. Remember, they had 6 months of forbearance, so they really didn't have to default. And now we're beginning to see that wave of defaults come this month. And now, in about 6 or 7 months, you're going to start seeing REOs, keys being returned, banks basically saying, what do I do with these? And that's where I think that there's opportunity. And, if there are people interested, I'm happy to give you names of funds that I've researched a little bit. and you guys can go invest in it yourself. And no, there's no opportunity to invest with me in hotels. I'm just a consumer of this, and I see this, that there was nothing wrong with this industry, and it just got slaughtered by COVID. It'll come back. Single tenant retail is also a huge opportunity. Basically, what COVID did was it separated single tenant retail from multi-tenant retail. In my mind, over the next 10 years, single tenant retail of the sort that you see on the screen is going to become very low cap rate. People will pay up for it. That's already starting, but we are in the middle of a pandemic right now. So obviously, asset prices are not rising. So there's a lot of these, all those things, forgetting them, but there's a lot of funds that focus on single tenant retail, and they also give you like 1031 type benefits. You might want to look at those, because I think that the price of these is going to go up a lot. I mean, people have really realized the value of, these kinds of anchor stores with food. So we already talked about office. So in my mind, I think office is going to be problematic. I think the big winner is on the screen in front of you. Industrial. This is an incredible asset class because it's the least sexy asset class, right? One of the things that I just heard me say before so many times is the least sexy things in life are the most sexy things in life. Nobody looks at industrial because it's just a bunch of walls and empty space. But why isn't that sexy? As a landlord, don't you want to be renting something that is just 4 walls and a roof? How many maintenance opportunities could there be in 4 walls and a roof? And imagine how quickly you can build industrial. It takes about 8 months to build industrial, it takes about 24 months to build multifamily. So take a look at this asset class. I am invested in this asset class. I am looking for more assets in this asset class, but right now is very difficult. So I don't have an open industrial asset open, and I don't think I'll have one for a while. So take a look at this. And I think that was pretty much the last slide. I think we've already talked about multifamily. The last thing I wanted to give you is what I gave you was about 1% of the research that we conduct. So as you can imagine, we have researchers at Grow Capital that are spending huge amounts of time gathering assets. So what we do is we give away a free toolkit to real estate investors. And all of these things that you see on the screen are in this toolkit. And each quarter we add in a section. So this quarter we added in a section for industrial because we think that that's a phenomenal asset class over the next 10 years. And so you can use any of the methods on the screen. You can use your phone to grab access to this. You can use the barcode on the screen, or you can go to that URL and you can grab access to all of our research. There's incredible amounts of research. Next quarter, we are going to be adding in senior housing. So if you're subscribed to the toolkit, it's free and it's always free. There's no subscription. There's no upsell. There's no special version that you have to pay $49 a month for. It's always meant to be free. So check it out. And next quarter, when we do senior housing and an update on how that industry is doing, we will send that information out to you, and you can check it out. And that is my presentation. And so you can grab the toolkit, and also we do about 20 webinars a year at multifamilyu.com. All kinds of webinars. We have actually 3 or 4 really powerful ones coming up. I'm doing one which is the impact of the election on real estate. And that's one that's coming up next week. Now that Biden's won, we have a much more higher level of clarity on what that does to real estate. So that will be coming up, I think, in about 2 or 3 weeks. So check out multifamilyu.com, and back over to Raj. Roger, you're muted.
I will go back. Hey, thanks, Neal. As always, blown away with the presentation. And guys, definitely what you see on the screen, download this toolkit. I bookmark it once you have it, and just keep visiting it as much as you can. Just tons and tons of value there. So Neal, bunch of questions, let's take them on. There's a lot of questions. I don't know how many we'll get through, but
sure.
I'll just take it in order. So shouldn't we be looking for the rolling averages of gaps between treasury and cap rate instead of snapshots?
The short answer is that when you look at a 20-year, the graph that I showed you was a 30-year graph. So it was from 1990 to 2020. It is a rolling average. Anytime you look at a 30-year timeline, in a way, you're looking at a rolling average. I think, and my point there was to show you that this average It goes up and it goes down. In 2018, real estate, not a preferred asset class. The gap was down. But in 2012, it was the best asset class in the world. And today, again, it might again be the best asset class in the world. And the point there was also to show you that we're helpless. We're all basically just, watching this. There's like people moving chess pieces, and it either makes real estate great or not so great. And so as long as you realize that, as long as you understand that your role is mostly that of an observer and understanding when your risk is high and when your return is high, I think you'll do well, right? Sure, I could probably give you a rolling analysis, but I think the insights are going to be the same.
Matt's asking Neal that with the Fed talking about keeping interest rates low for the foreseeable future, do you expect further cap rate compression going forward?
Absolutely. So I'm sticking my neck out here and saying cap rates in the United States must compress. The yield gap is too high. Every time we see the yield gap being this high, it eventually compresses. Is it going to compress this year? No, it might decompress. So keep in mind that multifamilies are sold based on something known as net operating income, or NOI. Well, NOI is dropping. It's been dropping since Feb, and it's going to keep dropping until a vaccine is found, right? So I expect that sometime in April next year, we will have an entire 12 months of post-COVID rents, right? Post-COVID stress. We call it T12 in the industry. So for the first time next year in April, you'll have a T12 with 12 months showing that distress in the marketplace and the lack of rent growth. Well, shouldn't that be the point at which prices are the lowest? That's my belief, that next April, you might see the lowest prices on the multifamily side. So you might see a decline there, 5, 7, 8%, nothing spectacular like 2008, but you might see a decline there. But I believe it's going to be very short-lived, because the moment the economy recovers and you get to a vaccine, that consumer confidence pushes up real estate. And so now I believe it's going to go the other way. So in my mind, here's my prediction. If you look at the cap rates in February 2020, before COVID, 3 years from now, I expect cap rates in the US for multifamily to be 50 basis points or half a point lower. So maybe if they were, I think it was 5.3 for multifamily in the US, that means we're going to be at 4.8 3 years from today. That's my prediction. Write it down and flame me in 3 years when I'm wrong.
Neal said it. You talk to him later. Neal, Partha's asking, wouldn't you say consumer confidence and retail sales are the same, not mutually exclusive indicators?
Repeat that again. You broke up for a second.
The consumer confidence and retail sales are pretty much the same and not mutually exclusive indicators.
They are mutually exclusive in the middle of a pandemic. Normally, they are the same, but the pandemic is having an impact on retail sales in a way that is extraordinary and different. So you have to track them separately. They're normally the same, but we're very far from normal right now. I want to take this question from Eric. So I've heard Neal talk about a new asset classes of build-to-rent townhouses. I forgot to mention this in my presentation. The largest opportunity in real estate, I believe, is a brand new asset class. It's called build-to-rent. It's not apartments, okay? It is either single floor or 2-floor townhomes that are built apartment style. So imagine, you go into one of these single family communities where people are living in all these single family homes and they have a big clubhouse and it's a gated community. Now imagine them being townhomes. That is the single greatest opportunity in real estate. A lot of that is being accelerated by COVID. It's basically people saying, I can't buy a single family home anymore, but I want to live in a single family. Well, you can't. I mean, the rents are high. Okay, how about townhomes? I still have the patio in the back. Yes, you do. I still have the little grass in the back. Yes, you do. So that is a phenomenal asset class. It's just beginning. It's 2 years old. REITs are being formed. The amount of money that is flowing in there is insane. And here's the thing that will shock you, right? As you can imagine, new asset classes have high cap rates, low prices, right? Just like storage 15 years ago was high cap rates, low prices. And then over time, the prices got higher. Today, build to rent is already lower cap than multifamily. It has such incredible advantages that it's lower cap today, 2 years after its formation. check out build to rent. I think that is a much bigger opportunity than even multifamily itself. I'll also take
yeah, sorry, I was just going to say, the question was, where do the mobile home parks stand in the whole mix of being impacted?
I think there's a very positive impact. I am looking at the industry. I'm seeing a very positive impact. Sudhi, the problem with mobile home parks is the NIMBYism against them. So people do not want new mobile home parks because they drive down real estate values for single family homes. So what is happening is people are not allowing new mobile home park zoning. If a city goes up 20% in population, it should go up 20% in mobile home park zoning, right? Well, we're not even seeing 5%. Well, as a result, what that means is you can't really build new mobile home parks. So the existing ones will go up in value. So I'm not sure they're a phenomenal place to be in right now because, obviously because of delinquency, but I'm looking beyond the pandemic. I think mobile home are a very good asset class, and no, I'm not involved in mobile home parks. I'm happy to give other people money for that.
Sorry, Neal, I don't know if you had picked the question, but Madhvi was asking about the storage industry. Is the demand too high right now? Do you see a needing to drop in the near future?
No, I don't think so. I think that if you think about what is the impact of COVID, 30 years from now, COVID is going to be seen as one of the most amazingly positive events in the history of the world. And I'm going to do a webinar on that because this is like looking way out into the future. Obviously, 1 million people dead is a horrifying event. But we now today look at World War II, where 10+ million people died. We look at that as an event that really changed the world for a better in so many different ways, right? Countries came together. The big impact of COVID is it basically frees people up to move where they wish, right? If that is going to be the impact over the next 10 years, why would there be less demand for storage? As people move more, they need more storage. Once again, I don't do a lot of storage projects. I'm mostly a consumer like you guys, giving money to other people. But I don't see the demand for storage dropping. I do see there being wild fluctuations in prices for storage over the next 12 months because a lot of those new construction projects, well, they can't fund them anymore, which means that somebody else will come and buy them, and those people will get a deal like the hotels. And when they do, they can have lower rents. So you might see some crazy fluctuations in pricing over the next 18 months as that new construction, kind of, wall comes in. There's a tsunami of new construction that will come in, and those will come in at cheaper rates than existing properties.
I've been told we have 5 to 6 minutes more left, so let me just pick questions at random here. What is the best strategy to earn steady passive return of double digits, inflation adjusted in the coming years? Neal, your crystal ball, please.
Boy, that's a really, really hard one. Passive double-digit returns. I don't know of any. I think that there are only single-digit high-quality strategies at this time in the US. Double-digit strategies don't exist as far as I know. So my answer to that is I don't know of any.
All right. And Neal, obviously, question about your data sources. Are they publicly available?
Some are, some are not. So obviously we pay for, so on the neighborhood side, we pay for Neighborhood Scout. On the city side, we pay for both housing alerts and the national subscription. We also pay for local market monitor, and then CoStar, which is a very expensive subscription. But more than anything else, we look at city-data.com, which is free data. So keep in mind, though, the biggest source of data for this presentation was none of those. The biggest source of this data is that I go out and subscribe myself to every single major player in real estate. I subscribe to their newsletter. And then our team gathers those newsletters in a folder called research, and we have a monthly meeting where we parse through it and look for insights. That's like 80% of this presentation, and all of it is free.
Yeah, and I saw some of the sources contributed to Marcus and Millichap, and people should know about them as well.
Thank you for joining us. Don't miss out on Passive Investor Ed 2021. Get your pre-sale tickets now. For more information, please visit us at www.passiveinvestored.com.